Hi, and welcome to our channel. Today we're diving into a powerful formula that can help you decide whether you should invest in tax-free municipal bonds or taxable bonds. It's called the tax equivalent yield formula, and by the end of this video, you'll know how to use it to determine which bond is right for you. Let's get started. First, let's clarify the difference. Municipal bonds issued by states or local governments are often tax exempt. That means the interest you earn isn't subject to federal taxes, and sometimes even state taxes. On the other hand, taxable bonds, like corporate bonds, usually offer higher interest rates but are subjected to taxes. How do you know which option is better for you? That's where the tax equivalent yield formula comes into play. Here's the formula. Tax equivalent yield equals tax-free yield divided by 1 minus the tax rate. This formula converts the yield of a municipal bond into its equivalent taxable yield, allowing you to compare apples to apples. Let's say you're considering a municipal bond with a 3% yield. Your federal tax rate is 32%. Plugging the numbers into the formula, we get 3% divided by 1 minus 0.32, which comes out to 4.41%. This means that a taxable bond would need to yield more than 4.41% to provide a better return than the municipal bond. Now, let's say you're deciding between two bonds with a $10,000 initial investment. A municipal bond offers a tax-free yield of 3%, while a taxable bond offers a yield of 5%. At first glance, the taxable bond might seem like the better deal, but let's see what happens after accounting for taxes. The muni bond yield is straightforward. It provides $300 in tax-free income. For the taxable bond, we need to factor in your tax rate. Assuming a federal tax rate of 32%, here's the math. We already know that the yield is 5% and you're investing $10,000, so that means your gross income is $500. Once we multiply that by your tax rate of 32%, you're going to owe $160 in taxes. So taking the $500 of income, subtracting out the taxes, your after-tax income is $340. Comparing that to the $300 the muni bond gives you, in this scenario, the taxable bond is a higher yielding investment. But here's the twist. What if you're in a higher tax bracket? Let's repeat the calculation using the top federal tax rate of 37% and a state tax rate of 8%. This equates to a total tax rate of 45%. So we already know that your taxable income is $500. So if we multiply that by the 45% tax rate, that comes out to $225 in taxes owed. If we subtract that from the $500, it comes out to an after-tax return of $275. In this case, the muni bond is a higher yielding investment after taxes. And there you have it. With the tax equivalent yield formula, you can confidently assess which bond option is better for your financial goals, whether it's maximizing returns or reducing your tax burden. Thanks for watching today's video. If you want to see exactly what we do for our clients in terms of reducing their tax bill, beefing up their investments, and planning for the future, or if you want to just book a quick telewealth call, click on the link in the description. See you on the next one.